Welcome to Big Money Monday on the Savvy Radio Show. Get ready, you are about to get paid. This show is designed to increase your financial intelligence every Monday.
Yeah, hello. How are you? It is Money Monday. Big Money Monday. My name is Stephen Van Kallenberg, and I'm the Savvy Landlord. Man, I'm stoked that you're even tuning back in. Money Monday number one was a little rough. I was a little struggle there. Still trying to get my bearings out there, folks, but hang on. Keep listening. I really appreciate it. Also, I really appreciate all the folks out there that encourage me. Just a couple quick disclaimers. I'm not an expert. I'm not reversed. I just go off of real world experience. Okay. I've been a real estate investor since 1999. And I've been dabbling for 10 or 15 years. And about 4 years ago, I got real serious. And this is a very important subject to me. Sometimes I say things that are not 100% accurate. Not that I'm trying to hustle. It's just my world experience. And so some things I leave out because I haven't really studied it so much. But my goal for the podcast in general, the radio show, is to get your interest peaked as high as possible so you would perform. A lot of people just don't do things because they think they can't do it or they don't know enough about it. And so my world is that I try to get you as much information as I can as quickly as possible so you can make a decision. At least you should go forward. Now, the things that I cover, especially money, you need to dip into it, study it a little bit more. There's a thing called Google. You might want to check that mess out. Google it up. And do your own research. So, again, my stuff is not necessarily perfect, right on the money. It's just real life experience, the circumstances that I have been through. So if that relates to you in any way, that'd be cool. Let me know. But other than that, let's dive into the Big Money Monday. Anyway, I know you like those intros. So first of all, let's just get right down to it. You need to close deals, all right? And how do you do that with no money? And you might want to do this on your first deal, but it's one of my favorite. And, when I was starting out and owner financed and try to get money and build relationships, a lot of experienced investors were using HELOCs, home equity line of credit. That's HELOC, home equity line of credit. Another thing is lines of credit. And so we're going to get into that here in just a minute. But basically, what you can do with a line of credit, you can close fast. You can offer cash and you kind of bypass all the drama. So that's one great thing about lines of credit. Here's an interesting thing. So what I've learned through when I was started out 10 or 15 years ago, I was like, man, I wish I was like that investor. I wish I had cash. And they necessarily don't have cash. They have lines of credit. So here's a strategy that I thought was the next level. And I definitely think that you should consider this strategy straight at the gate. You purchase a property with a line of credit, and you can get that line of credit. A lot of people assume that it's on your home, right? On your own home equity, and they're all nervous that what if the deal goes bad and you lose your home? You can do lines of credit on paid off homes. So for example, like say you have 10 homes, and you can refinance all 10 and then pull out all the equity and then take that money and pay off 2 of those homes. So you got 2 debt-free out of 8 or 3 out of 7 out of 10. And you can go to a bank, and there's different banks have different programs. But there's a bank that I work with that gives me a line of credit based on debt-free assets. And I use that. Now, it's not 80%, 90%. It's only 60%. But in my world, I'm cash flowing like a monster off those debt-free properties, and I'm also leveraging that property with a line of credit. And with that line of credit, I can go make a cash offer, beat pretty much a lot of people, at least 50% of people trying to get into real estate, close quickly, hold on to the asset for a little while, and then refinance it. So that's one strategy. And actually, I think that's the next level strategy if you're struggling as a real estate investor. I always wanted to do that strategy. I didn't think, how could I get lines of credit? I don't have a home with equity in it. I'm telling you, when you just keep faithful in what you're doing, grinding it out, little by little, you'll get to that point, and then your life will be so much better, faster, and it's amazing. Well, first of all, let's cover what is equity. To be super simple, equity is what's left in the property of the value. So let's just say it's $100,000, and who deems these values? But let's just say you got a full appraisal. The house is worth $100,000, and you purchased that property for $50,000, or you paid it down to $50,000, or whatever the case may be. But you only owe $50,000 on it. Well, this other $50,000, so $100,000 minus $50,000, that gives you $50,000 of equity. Okay, and that equity is now has some value to it, and you can borrow against it. Now, a HELOC is real easy. So if you have a $300,000 house and you've paid it down, you put a good down payment on it, and you've been paying it down for 10 years, and say you only owe $200,000 on it, and in essence, you have $100,000 worth of equity, and so you can borrow against that equity on a HELOC. So that's where that all comes from. And let's just say you got $50,000, boom. Now you can, when you do this process one time, you fill out an application like a loan application. They come out and usually do an appraisal. And this goes for lines of credit collateralized, backed by your rental property. And then, boom, you got this like checkbook in the sky. Now keep in mind, here's a couple key things that you need to be aware of. When you do get lines of credit and you're dealing with a kind of a big bank, it goes on your credit report that you kind of have this giant credit card in the sky of home equity loan, and only when you exercise it. So let's just say you live in a $300,000 house and you have $100,000 equity. It's just sitting there. You come across and you hear about a deal of $75,000 deal, and 3 years later you're still sitting on this equity. Boom, and you gobble that up. Now that $75,000 usually goes up on your credit report. Now, here's the interesting thing. If you do a HELOC, some banks, they will kind of guarantee it for 5 years, and it's a set rate. And then after 5 years, it usually goes into permanent financing. The goal and the why you should do lines of credit is to move the money. It's velocity. Banks love when you borrow money, pay it back, borrow money, pay it back. And you should just do it for fun anyway, not for fun, because a lot of people can get in trouble with lines of credit. And I've seen tons of investors go down. They keep buying deals, rack up a huge lines of credit debt, and then they're not even getting their assets, their rental property, in conditions to create income, cash flow, to pay down their debt. So, like I say before, I may have said it before in another podcast or whatever, but I look at lines of credit as, or debt in general, like a loaded gun. You can do very well with it, or it can be your demise. So you got to manage it like anything else. All right. Another way to use your line of credit, you can use it for a down payment on a big property. So let's say that you're trying to buy an apartment building and it's commercial money, and you got to come up with 30, 40, 50,000 to close the deal. And I've had to do this before. I refinanced 2 small properties so I can acquire a commercial property, because usually a commercial loan, a commercial property is required for you to put down 20%. Now, I'm a big fan of no money down. Banks are no fans of no money down. But when you do a commercial property, it is super serious. They usually don't do no money down unless you're acquiring the asset by assuming the loan or a master lease or some other function that you can't acquire a commercial property without a loan. But if you're going to get a loan and you're trying to buy a commercial property, and that may be a commercial building, a warehouse, or even an apartment building per se, you're going to have to come up with 20%. Usually. Now, there's other ways around it, and I've done deals in different ways. So you can use this line of credit, this access to cash, for a down payment, to gobble up an asset, hold it, and then sell it. Then not sell it, but then refinance it. A lot of flippers do it that way. I don't believe in flipping, but whatever. And you can grow your business just skyrocket. So here, let me give you a scenario. So you find a deal, like I said earlier, $50,000 deal. You gobble it up with your line of cash. Didn't cost you anything to do that, except for the original appraisal. You buy the property. Say you put another $10,000 in it. So you bought this $100,000 property for 50. You put another 10 in it. You got 60. You hold on to it for 30 days, maybe 60, maybe 90 days. You call any bank, pretty much should refinance that for you because it's under 70% of the value. And then you get all your money back. This is where investors go wrong. They take that money and recycle it again. No, pay the line of credit back and start all over. So that is a Money Monday way of buying real estate, and I think it's the next level for you as a real estate investor if you're just grinding it out slowly. I always dreamed of doing it that way, and that's how I pretty much do it now. Now we're on partnerships. Now partnerships can be very powerful in a lot of ways. First of all, you got someone on your team. And another way it's powerful, it could be your demise. And, I haven't heard anything super positive with partnerships. I just haven't really pursued them. I've done a podcast not too long ago on a deal that I did do with a partner, and it went smoothly. It's just, what happens if this happens? What happens if you have to need cash, or you have to move, or you have to liquidate, or whatever the case may be? Partnerships can be tough as well. But the great thing about partnerships, here's a quick scenario. You got a guy that has a lot of money and he's busy. Usually people that have money are busy. They're building other businesses, or they're going in a different direction, and they have money and they want to use their money and make it active. And that's the whole goal of money. And they call you up, and you are a real estate investor, or you call them up and you say, hey, let's partner on a deal. And so this is a deal that I did. I found the deal. My partner funded the deal. He was a passive investor. I managed the deal, and we both split the equity of the sale and also the cash flow. So partnerships are good. You can also use partnerships quickly to fund a deal, like a transactional funding. Say you call up a guy that has some cash and say, hey, I need you to fund this deal. And that's another way to have partnerships. So, I don't know. I have very limited knowledge on partnerships, but it is another way to get money. So the most important thing is that you got to fund the deal, but you got to find the deal. So those are two kind of yin and yang. You got to find the deal. You got to fund the deal. Find fun. And it's all fun. But, you might have to lay down and have a partner to close a deal here and there. So you should study that and figure that out yourself. I'm on commercial loans. Commercial loans, like I mentioned earlier, require 20% down, but they're out there. Anytime you're owner occupied, it's pretty simple on a commercial. So if you have an office building, and another thing about commercial loans, sometimes they're assumable. And I know with accelerated mortgage, and people are going to get buck wild on me when I say assumable. I know it's out since the 80s, but you can deed into a trust like your loan, and you could have someone be the minister of the trust. So there's ways around it, but commercial loans are pretty flexible in the regard of they just want it to get paid. And I know a lot of commercial people acquire assets from people that have just been burned out. All right. And here's an interesting, and I'm going to end with this. I know this is kind of erratic today, but man, it's Monday, it's early, and you're probably thinking the same thing. So let's finish up with a cool one that you may not know of. And if you do know of this one, that'd be really cool, because all the years, I probably just figured this out maybe a year ago. And this is just from having relationships with a banker and having lunch. And he's like, why don't you just do a participation loan? I'm like, I'm sorry, buddy. What is a participation loan? Well, a participation loan, say, for example, you have each bank has a different level of different amount of money that they can loan. It's a percentage based on their assets. So, for example, this bank that I deal with, their assets are worth about $50 million, and they can only loan to one customer the maximum of $1.2 million. Well, that's whack, but that's a lot of money. But for that real estate investor per se, that's all they can borrow is $1.2 million. So, but that real estate investor, if they're at $1.2 million with that bank, and they say they're $1 million at another bank, they're just starting out, they really want to grow their business, their empire. And so what that little bank can do, it's a community bank, they can participate in a participating loan. Huh, really? Yes. So let's just say you have $1 million at that bank and you really want to borrow more money. So you can suggest to that loan officer, and usually you want to go with a senior loan officer, not a vice president loan officer or a vice president, or not a junior, but that's another day. We should cover that as a podcast. And you can suggest doing a participating loan. And what they do is they find another bank. That bank takes some other bank, loans them money, and takes that loan out of the bank, and then they service that loan for you. So you still pay the bank the amount of money. Say that payment's $10,000 a month, and you still make that $10,000 payment. But what they do is they take it, and they've basically sold the loan, or they participated it out to the other bank, and they make a very small percentage, half a point. That other bank behind you, or that they participated it too, they're happy, and they have income coming in. So you might want to consider that. I have not done a participating loan. It's I would say, I don't know if it would be the word advanced, but it's not a common language that's around. But I'm in the process of pursuing that because I like this little bank that I use, and I want to continue to do it because they do cash out during acquisition, which is not impossible but rare, and it's just so convenient that they just loan 75%, 70% on ARV, depending on what level of customer you are. So that's it on Big Money Monday. 16 minutes of all over the place, not perfect, but still getting my bearings. Anyway, thanks for listening to the Savvy Radio Show. It means a lot to me when you walk up to me or email me and say, hey, thanks so much. If you want to listen to other episodes, go to thesavvyradioshow.com, and I'll see you sometime at a Mr. Landlord conference coming up.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook, and always be buying assets.